Depreciation recapture is a tax provision that allows the Internal Revenue Service, IRS, to collect taxes on the profitable sale of a depreciated asset. It's a concept that might seem complex, but property owners and investors must understand. Why? Because it can significantly impact your tax liability when you sell an asset. Depreciation recapture comes into play when you sell a depreciated capital asset for more than its adjusted cost basis. The adjusted cost basis is the asset's original cost minus all depreciation claimed. The IRS treats the profit from the sale as ordinary income for tax purposes, not as a capital gain. For example, if you purchased a rental property for $200,000 and claimed $50,000 in depreciation over the years, the adjusted cost basis would be $150,000. If you later sell the property for $220,000, you would have to recapture the $50,000 in depreciation. Calculating depreciation recapture can be a bit tricky, but here's a simplified step-by-step guide. 1. Determine the cost basis. This is the original purchase price of the asset. 2. Calculate the adjusted cost basis. Subtract the depreciation you've claimed over the years from the cost basis. 3. Calculate the sale price. This is the amount you sold the asset for, minus any selling expenses. 4. Determine the depreciation recapture. If the sale price is higher than the adjusted cost basis, the difference is considered depreciation recapture. Remember, the IRS has specific forms, like Form 4797, to report depreciation recapture, so it's essential to keep accurate records of all your depreciation claims. Examples of depreciation recapture. To better understand depreciation recapture, let's look at 2 examples. Depreciation recapture on rental property. Suppose you bought a rental property for $300,000 and claimed $100,000 in depreciation. The adjusted cost basis is now $200,000. If you sell the property for $350,000, you have a depreciation recapture of $100,000 and a capital gain of $50,000. Depreciation recapture on equipment. Suppose you purchased equipment for your business for $20,000 and claimed $5,000 in depreciation. The adjusted cost basis is $15,000. If you sell the equipment for $18,000, you have a depreciation recapture of $3,000. Depreciation recapture can significantly impact your tax bill. The recaptured depreciation is considered ordinary income and is taxed at your regular income tax rate, which can be as high as 37%. Any remaining profit from the sale is considered a capital gain and is taxed at a lower rate, which can range from 0% to 20%. While depreciation recapture can lead to a higher tax bill, there are strategies to minimize its impact. 1. 1031 exchange. This allows you to defer paying taxes on the sale of a property if you reinvest the proceeds in a similar property. 2. Installment sales. By spreading the sale of a property over several years, you can spread out the tax impact. 3. Charitable contributions. Donating property to a charity can provide a tax deduction and avoid depreciation recapture. One common misconception about depreciation recapture is that it only applies to real estate. In reality, it can apply to any depreciable asset, including equipment, vehicles, and machinery. Another common error is failing to accurately track and record depreciation. This can lead to miscalculations when it's time to sell the asset and can potentially result in a larger tax bill. Depreciation recapture is a critical concept for anyone who owns depreciable assets. While it can increase your tax liability when you sell an asset, understanding how it works and how to calculate it can help you plan and potentially minimize its impact. Remember, this video is intended to provide a general understanding of depreciation recapture. For advice tailored to your specific situation, consider consulting with a tax professional or financial advisor. In the end, knowledge is power. The more you understand about depreciation recapture and other tax implications of owning assets, the better equipped you'll be to make informed decisions and optimize your financial outcomes. Thank you so much for watching. If you enjoyed this video, please give it a big thumbs up by hitting that like button below, And make sure to hit the subscribe button and turn on those notifications so you never miss any of our future uploads. We have a lot of amazing content lined up, and we can't wait to share it with you.